This week is a big week. Not only are rates going up another 0.25%, guaranteed. In fact, I think it's like a 99.2% chance. So there's 0.8% of someone, there's some 0.8% of people who don't think there's going to be a hike, but it is pretty much guaranteed, guys. So Fed's raising prime another quarter. That is the highest. So he's raised it 5.5% over the last year and a half or so. That is the highest it has been in over 20 years. So that's pretty unprecedented. That being said, though, you know how the Fed keeps talking about this soft landing? Everybody keeps talking about the soft landing and everybody wants to say, but jobs are really great. Well, there's this little thing called the leading indicator index. And what that does is it basically predicts based on the past, based on history, it predicts the future. So that leading indicator index right now, I believe has just passed neutral territory according to everything that we've looked at, which means that the likelihood, according to the leading indicator index, of a soft landing is kind of seems impossible, actually, at this point. Now, that's not to say that everybody should freak out and think that we're going to go into this like 2008 style Great Recession or anything like that. It just doesn't mean, it just means that I don't think there's very much of a chance for a soft landing, okay? Because basically what happened with the leading indicator index is as it goes down, it hits this kind of neutral zone. And at that point, the Fed basically has two options. So A, they could do something to shock the economy, which is like a pandemic or 10 consecutive rate hikes or a bunch of examples of things that might shock the system. Bank failures, that would be another one. Or they could accommodate to achieve this soft landing, basically stop with the rate hikes and stop with the credit tightening to go, hey guys, based on all of our indicators so far, inflation's come down really far. The economy is starting to pull back. The consumers are starting to pull back. Maybe we just sit and wait it out because I think we've done our job here. Well, they're not doing that, right? They're doing another rate hike this week. So that means that they're continuing on with the rate hikes and the credit tightening and all of that. So it just makes having that soft landing a lot less realistic. And so like I said, everybody's talking about jobs. Well, if you take that leading indicator index and overlay the 3-month job report there, you'll see that at a similar point in the cycle, we definitely have more jobs now than we have at previous pivotal points in the cycle. But you would see it on this leading indicator index with that 3-month jobs report overlaid over there at these pivotal points, that jobs don't start going down at this point going into a recession. They don't start going down yet. It just hasn't happened in any of the previous cycles. So all of this stuff that you're seeing on the media about how jobs are so strong and this soft landing and everything, they are not taking this into account, right? Because it's not going to get the views, right? So it's not going to get the attention that we get with all of this panic or this, no recession stuff or these fabulous job reports that are coming out. So that being said, I do anticipate that we will see jobs. I think we're going to start shedding jobs soon. It's already started. It's already happening, but I think we're going to see it at a faster pace. And a lot of people think the rubber's going to hit the road here in about September. So this is like the last hurrah for a lot of people in the economy before they really start feeling it, before they've gone through most of their savings and they're like, all right, guys, we got to cut it back. Basically, just because the pain isn't here yet, it doesn't mean that it's not coming. And it also doesn't mean that we're going to have another 2008 style recession. That's not what I'm saying, but I am saying that I don't think we're going to have a soft landing. That being said, now that the Fed's going to increase rates 0.25%, I think a lot of people in the market are really looking for him to soften his tone. They think that he will soften his tone, but the general consensus among the economists and the people that I listen to is that we're not going to see that tone really soften. It doesn't mean that, it still looks like this is the last rate hike. At least the market thinks so. In fact, it says there's about a 16% chance of a rate hike in September. So I think the market overall feels that we are done with rate hikes, but it doesn't mean that the Fed's going to start softening the tone of his language. He's going to kind of say there's still more work to do. There's still some stuff to get done. There's still some things that we need to achieve. So he's not going to soften the tone, I don't think. That being said, so there's a 16% chance of a hike in September, and there's a 9% chance of a rate cut this year, which means that the market really does not think there are going to be any rate cuts. We've kind of solidified that. The first time that there's over a 50% chance, or that the market sees over a 50% chance of a rate hike, is in March of 2024. So as of now, obviously things can change, but the market is saying that there's a greater than 50% chance of a rate hike around March of 2024. So that's the end of Q1, right? Let's see what else. So basically this week we have GDP and inflation also coming out in addition to the Fed hiking rates again. So we're going to look out for that. That will be interesting news for us to look at. And the last thing that I want to mention to you guys is, we've talked about how financing is tough. I have mentioned in the past that a lot of lenders are trying to shore up their balance sheets because they don't know what new rules are coming down the pipe. One of my bankers just sent me an article last week basically talking about this very thing is, hey, this is why a lot of banks are not lending or they're raising their spreads and they're being very picky about who they lend to is because they're trying to shore up their balance sheet, and we anticipate this to go on for a while. So basically on July 27th, in just a few days from now, they are going to propose some of these hikes or this increased capital requirement for banks. But there's going to be a lot of arguments around that, right? Because there's a lot of people, especially like bank CEOs and bank presidents, that don't feel like the capital requirement should be increased. They feel like it really isn't warranted. And of course, so basically the Republicans don't want that to happen either. So this is going to be an ongoing debate. It's going to take a while. So just because they're proposing these new standards for banks on the 27th, it doesn't mean that it's set in stone. There's going to be a lot of back and forth about this. It's going to take many, many months to get through, which is why we think that banking will continue to be tight. Credit will continue to be tight because banks are preparing for having to increase their capital requirements by as much as 20%, which is pretty large. So anyways, that being said, there is financing available out there. I've talked about this a lot, especially if we're looking at multifamily. Thank God we have the agencies in San Diego or Southern California. We haven't had to do a lot of agency debt. The only times I tend to do more agency debt is in times like this when the economy is getting a little rocky because we have so many fabulous bank options, right? So we still do have a lot more bank options than other parts of the country. I have literally talked to other clients or other people who are investing out of state, and lending is tough out there for people. Okay, it's really tough. So we, compared to the rest of the country, have a lot more bank financing options here, but compared to what we had maybe a year ago or 2 years ago, it's a lot less, right? So, but we do still have options for financing. Thank God for multifamily, we have the agencies, and then we've just got to get creative with other, property types. So for example, office is obviously going to be tough because of all those CRE defaults that are coming down the pipe. They've already started really on a lot of the bigger stuff. There's just a lot going on right now. It's a big messy pot when it comes to credit, banking, lending, real estate in general. It's become a little bit more murky, but we do still have those financing options available. I am starting to see the market move a little more. I'm seeing more offers on properties. I'm seeing people trying to do more deals. There's not a lot that's actually going forward. I think we're still at a little bit of an impasse, but I am starting to see more activity, and that is encouraging. So you guys have a fabulous week. I will talk to you next week after the Fed's hiked rates, after we get new GDP and inflation readings, and we will see how things are going. But I anticipate we're going to see better numbers because that is what we've been seeing all year pretty much. So hoping to see those numbers better so that way we can pretty much solidify the fact that there will not be another hike in September. Have a fabulous week. I will see you next week.